This earnings season, plenty of companies delivered big beats. However, those that missed expectations saw sharp drops in their stock. Our guest is cautious about the forthcoming earnings season. He says that the impact of tariffs is likely to be felt, and he also has 3 stock ideas. We're joined by Tyler Ellegard, Portfolio Manager at Gradient Investments. Tyler, great to see you. Thanks for joining us.
Thanks for having me, as always.
Talk to us about this weakness in tech stocks that we're seeing. I mean, is it really just a bit of profit taking after the massive run they've had?
I think so. I mean, if you look at the quarters that these companies have had, they are the companies that are driving the earnings growth for the S&P 500. And so I think it's really just a repositioning, taking some profits off the table and waiting for these pullbacks, because these names have gotten expensive and they've had a nice run up since the April lows.
And nothing keeps going up forever. And yeah, I mean, they are interesting. I've heard at least one money manager saying this is not pets.com. They have massive sustainable businesses and huge profits.
Yeah, that's 100% true. We agree with that same concept, right? It's not the 2000s, 2001 .com bubble, right? These companies are highly profitable. They have significant cash flows. The .com era was filled with companies changing their names to end with .com, whether they're profitable or not. And so it's a very, very different feel. And so it's also, you're seeing the incumbents are the ones dominating this space rather than new entrants into the space. Yes, we have the open AIs that are still private, but generally speaking, the companies that are winning this tech AI battle are the big names like the Microsofts, the Googles, or Alphabets, the Broadcoms, NVIDIAs, the companies that have already been very well established and have the cash flows to support this massive CapEx cycle that they're doing.
Yeah, it's just incredible, isn't it? Mark Zuckerberg of Meta building one server farm that's going to be the size of Manhattan. It's just mind-boggling. You are wary, though, of the forthcoming earnings season because you note that companies that have missed over the past while have seen their stocks take a drubbing.
Yeah, it's been really interesting to see this past earnings season and even maybe a look through into what we can expect for next earnings season. But if you look at the companies that have beaten expectations or raised guidance, they haven't been rewarded, right? I think the stocks on average are up about 50 basis points to 1% for the companies that have beaten expectations. But for the companies that have missed expectations or even come in line with expectations, the stocks have been severely punished, right? The average is down anywhere between 6 to 8% for the stocks that have come in line or missed expectations. So it's been interesting to see. And I think a lot of it is on the high valuation names or the names that you could call priced for perfection. Mm-hmm. I think it's truly that the stocks coming into the earnings season, those stocks were priced for pure perfection. And if they didn't deliver that or even increase that potential growth factor for the company, they were punished. And on the lighter valuation side, I think it was more. So I think there was a bifurcation there. But for the lighter valuation side, I think it was really just the investors losing interest in the continual misses on expectations. So it's just been a very interesting earnings season to pay attention to.
One stock that you're watching is Eaton Corporation. Now, they are a supplier of electrical gear. There's been near euphoria over the big build out of power to fuel all this AI. But you think too much optimism may have been built into Eaton, symbol ETN?
Yeah, I do. We still really like the name moving forward, just for the U.S. CapEx cycle that's happening and where they sit in that data center supplier. But Eaton is a perfect example of that stock that came in line to slight beat, but the stock was down 5% on the earnings. And the company, all they did was they raised the midpoint of their guidance, but lowered the top end, right? Mm-hmm. Which means that potential higher growth factor wasn't there, and so the stock fell 5%. So I think generally speaking, this stock is a great stock to own going forward, regardless of how expensive it is right now, just because of the current CapEx cycle that we're in.
And you do say that there are signs of a broadening with this other stocks getting some life as some people move out of the Mag 7?
Yeah, and that's really what you're seeing right now, and taking those profits and moving outside of the tech sector, the Magnificent Seven. But I think a broadening out is good for the overall market, right? We don't want to see the sole leadership in the Mag 7 or the top 10 names because that's already a significant concentration for the market. And so we need to have this broadening out. It's a healthy part of the market when you see other stocks, other sectors working.
You have some stock ideas for us. Smucker, JM Smucker, they're in coffee, they're in jam. I presume they're still in jam. You like the look of them?
I do. I mean, the stock has been terrible the last 2 years, 2.5 years. There's been some headwinds on their Hostess acquisition, some headwinds for the coffee. Coffee beans have been expensive. But I think a lot of that is going to start to turn into tailwinds here. Coffee comps are getting better as consumers switch to more value-oriented rather than maybe going to the Starbucks or the Dunkin' store. Maybe they go and buy the Folgers or the Dunkin' at home as a better value proposition for them. So I think there's more tailwinds at this point for the company. And then the Uncrustables business just continues to be a driver for their growth. They have pricing power there as well. So like the stock, cheap valuation and some potential tailwinds and catalysts coming forward in the next couple of quarters. You
have a name, Martin Marietta, a big supplier of building materials. You see potential there?
Yeah, we really like this play. The stock is near its lowest or lower valuation, not the lowest, but lower. They just reported a great quarter, great EBITDA growth, great margins. But they're in that cement aggregates business. And so when you think of this U.S. CapEx cycle and onshoring from the tariffs, I think this is a great play to have in a portfolio.
And finally, Welltower. It's a REIT that invests in healthcare infrastructure, and you see potential there?
Yeah, and it's really more geared towards senior living. And so when you think about the baby boomers here in the U.S. and even in Canada, and the pricing power that they have just from the sheer demand and not really enough supply right now. And so their ability to have that pricing power and their continual investment into new buildings is going to set them up really well for the future.
Right. I had to remind myself what are Uncrustables and their frozen from Smucker and their frozen sandwiches. Thank you very much. Thanks very much indeed. Tyler Ellegard, really appreciate it, Tyler. Portfolio manager at Gradient Investments.